Hey everybody, Dr. Phil here. This is going to be a video on corporate finance and an introduction to corporate finance. So let's talk about cash flows and financial statements. Let's take a closer look briefly. So financial topics are usually grouped into five main areas. So the first is corporate finance. That's the focus of this video. The second is investments, which deal with financial assets. So we can think, for example, stocks and bonds. Financial institutions. So think about businesses like banks, insurance companies, international finance. These are careers that generally involve international aspects of either corporate finance, investments, or perhaps financial institutions. And then finally, fifth, fintech, which is the combination of technology and finance. That fintech term is one that you've heard more about recently. So what is corporate finance? So, broadly speaking, it's the study of ways to answer three questions. So, the first is what long term investments should you take on? That is, what lines of business will you be in, and what sorts of buildings, machinery, and equipment will you need? So, obviously, there we're talking about a firm standpoint, not necessarily an individual standpoint. Number two, where will you get the long term financing to pay for your investment? Will you bring in other owners, or will you borrow the money? And number three, how will you manage your everyday financial activities, such as collecting from customers and paying suppliers? So owners, that is stockholders, think about people like us, of large corporations, are usually not directly involved in making business decisions, especially on a day-to-day basis. So corporations employ managers to represent the owner's interests and make decisions on their behalf. Financial management function is usually associated with a top officer of the firm, such as a vice president of finance or the chief financial officer CFO. The VP of finance coordinates activities of the treasurer and the controller. The controller's office handles cost and financial accounting, things like tax payments, MIS, Management Information Systems, MIS. And the treasurer's office is responsible for managing the firm's cash and credit, financial planning, and capital expenditures. So here we see an example of a simplified example, obviously, of a organizational chart. So no need to, commit this to memory. This every company is going to look a little different than this, but this is generally how it's going to flow, right? Board of directors at the top, the chairman of the board and the CEO, chief executive officer, will report to the board of directors. The president and COO, chief operations officer, will typically report to the chairman of the board and CEO. Reporting to the COO and indirectly the people entities above that, the VP of marketing, the VP of finance, also typically called the CFO, again, chief financial officer, and the vice president for production. So in this example, the CFO below them has the treasurer and the controller reporting to them, and then so on and so forth, working its way down, the hierarchy, if you will, of the organization. So the financial management must be concerned with three basic types of questions. So the first is capital budgeting. And this is the process of planning and managing a firm's long-term investments. Things like evaluating the size, timing, and risk of future cash flows, which is the essence of capital budgeting. Number two, capital structure. This is the mixture of debt and equity maintained by a firm. So think about debt as like bank loans, issuing bonds, equity as issuing shares of stock. So how much should the firm borrow? That is, what mixture of debt and equity is best? And what are the least expensive sources of funds for the firm? And number three, working capital management. So this refers to a firm's short-term assets and also liabilities. So think about like the cash, the money you have and the things you owe, kind of in the short term, day to day. Now, the forms of business organization. So there are really mainly three. We have the sole proprietorship, we have the partnership, and we have the corporation. As it notes, most large firms in the US are almost always organized as corporations. So let's talk a little bit about each one. The sole proprietorship, think about the name sole, individual, right, on your own, is a business owned by a single individual. Some of the pros, it's very simple to start. It's the least regulated form of organization, and the owner keeps all the profits, which is, of course, is nice. The disadvantages include that the owner has unlimited liability for business debts. That's a big one. All business income is taxed as personal income. The life of the sole proprietorship is limited to the owner's lifespan, and the amount of equity that can be raised is limited to the amount of the proprietor's personal wealth. And the ownership may be difficult to transfer. For respect to a partnership, this is not just necessarily two, but like two or more individuals or entities. It could be a general or a limited partnership. Pros and cons are basically the same as the sole proprietorship. But one of the big disadvantages of both sole proprietorships and partnerships is, and it's a very big one, is the inability to raise cash for investment. There's unlimited liability for business debts on the part of the owners. That's true if you're a general partner. If you're a limited partner, that's not going to be the case. Obviously, there's a limited life of the business. It doesn't, it doesn't go past, if the partners pass away, then the business basically folds, um, goes into receivership, and difficulty of transferring the ownership. So the corporation, this is a business created as a distinct legal entity composed of one or more individuals or entities. So it's basically a legal person. So it's separate and distinct from its owners with many of the rights, duties, and privileges of an actual person. And the stockholders and managers are usually separate groups. Um, the advantages include the following. The ownership can be easily transferred, readily transferred. So think about somebody just selling their shares of stock to somebody else. It's very simple to do that. The life of the corporation is unlimited, and the limited liability for the stockholders. That's, of course, a big one for the stockholders. A significant disadvantage includes the following, and that is double taxation. Now, this happens because corporate profits are taxed as income tax, and then they're taxed again, at least the dividends part. When the dividends are paid out, then we as individuals or whomever receives the dividends has to pay capital gains tax on the dividends. So, corporate form of organization has many variations worldwide. It could be referred to as joint stock companies, that's more, and public limited companies, PLC, or LLC. They're more sort of like Commonwealth terms, but you do see the LLC that's very, very prominent here. A benefit corporation is for profit, but it has three additional legal attributes. One, accountability, which refers to the fact that a benefit corporation must consider how an action will affect shareholders, employees, customers, the community, and the environment. And number two, transparency, which means that in addition to standard corporate reports, Benefit Corporation must provide an annual report detailing how the company pursued a public benefit during the year or any factors that inhibited the pursuit of this goal. And number three, purpose, which refers to the idea that a benefit corporation must provide a public benefit either to society as a whole or the environment. Now, with respect to the goal of financial management, of course, in a for-profit business, the goal of financial management is to make money or add value for the owners. So, what are some possible goals, financial goals of a corporation? So, the goals will typically fall into two classes. The first is profitability goals, which relate to different ways of earning or increasing profits. So, making more, generating more revenue, more sales, market share, controlling costs. And number two, goals focused on controlling risk. So, for example, avoiding bankruptcy, trying to be stable and safe. And from the stockholder's point of view, what is a good financial management decision? Well, the goals of financial management is to maximize the current value per share of the existing stock because that's what increases the firm's market capitalization. So, what is the appropriate goal if the firm has no traded stock? And that does happen. So, the goal then is to maximize the market value of the existing owner's equity. The goal does not imply the financial manager should take illegal or unethical actions to increase the value of equity in the firm. And one of the ways we help prevent this is what we call Sarbanes-Oxley, SOX. It was enacted in 2002, and it's intended to protect investors from corporate abuses. So some key requirements of SOX, obviously it's legislation, it's very long, but some key requirements include Section 404, which requires each company's annual report to have an assessment of the company's internal control structure and financial reporting. The officers of the corporation must review and sign annual reports, and the annual report must list any deficiency in internal controls. Let's talk now about the agency problem and the control of the corporation. So the relationship between stockholders and management is called an agency relationship. This exists when somebody, i.e. the principal, hires another, the agent, to represent his or her interests. The agency problem is the possibility of conflict of interest between the stockholders and management of a firm. Agency costs refer to the costs of the conflict of interest between stockholders and management. And indirect agency costs are lost opportunities. Direct agency costs can come in two forms. So the first one is corporate expenditures that benefits management but costs the stockholder. So for example, private jet travel would be one. Number two, expenses that arise from the need to monitor management actions, again, to try to make sure that they're doing what's best for the shareholders. So do managers act in the stockholders' best interests? So managerial compensation. Management will frequently have a significant economic incentive to increase share value for two reasons. Number one, managerial compensation is usually tied to financial performance in general, and often to share value in particular. And two, managers who are successful in pursuing stockholder goals will be in greater demand in the labor market and thus typically command higher salaries. With respect to control of the firm, stockholders ultimately control the firm as they elect the board of directors, who in turn hire and fire managers, as we alluded to earlier. And existing management may be replaced by stockholders via proxy fights and takeovers, and I'll probably discuss those in a later video. Let's now talk about stakeholders. So we talked about stockholders. You hear this term stakeholders, like what does that even mean? So management and stockholders are not the only parties with an interest in the firm's decisions. Employees, customers, suppliers, even the government all have a financial interest in the firm. Perhaps even people that just live locally could be affected by the firm's actions. So, for example, maybe they pollute a local river. So we can think of a stakeholder as someone other than a stockholder or creditor who potentially has a claim on the cash flows of the firm. Such groups will also attempt to exert control over the firm, and this could be to the detriment of the owners. So let's talk now about financial markets and the corporation. So a financial market is just a way of bringing buyers and sellers together to buy and sell debt and equity securities. And we kind of alluded to what those were earlier in this video. Most important differences between financial markets concern the types of securities that are traded, how trading is conducted, and who the buyers and sellers are. So then we get into what's called primary versus secondary markets. So in a primary market transaction, the corporation is the seller and the transaction raises money for the corporation. So think about that like the very first time they sell the stock or they issue the debt, that's the company doing it. Think about the name primary as in first. Public offerings involve selling securities to the general public. Private placements are negotiated sales involving a specific buyer. Now compare that to a secondary market transaction, which involves one creditor or owner selling to another. And this serves as a means for transferring ownership of corporate securities. So think about the secondary market transaction as every time that the stock of the company is then traded between whoever, not the company this time, right? That was just a primary. I sell it to you, you sell it to your friend, so on and so forth. All right, thanks for watching this video, and I will see you all in a future video. Take care.